Take a quick look there at the impact higher rates are having on the real estate sector. Real estate, the white line, down 14% in the past 3 months, while yields have jumped about a full point. And with just 2 days until the Fed decision and amid lingering concerns about commercial real estate, let's dig into two of the big names reporting after the bell today. Morgan Stanley's REIT analyst Ronald Kamdem joins us now with the action, the story, and the trades on Vornado and Simon Property. Ron, it's great to see you again. Welcome.
Great to be here.
Let's start with Vornado, one of New York City's biggest landlords, nearly 20 million square feet of office space. Its shares are down 17% over the past 2 months. And you note that expirations at 1290 Avenue of the Americas will be a key driver for their occupancy outlook. Vornado also has no unsecured debt maturing until 2025. They could improve their capital structure with a potential sale or mortgage against the Farley building in Midtown, you say. What would you do with the stock here?
Yeah, it's a good question. So what we've learned so far during the office earnings season is that, number one, the return to office has stalled about 50 to 60%. So you're not seeing any more pickup from there. And number two, tenants are still being very deliberate. They're still taking their time before committing for space. So I think the first thing we're going to be looking at is leasing activity. And as you sort of mentioned, 1290 Avenue of the Americas is a big one because they have a large expirations there. If they're not able to sort of get new announcements, new tenants signed there, that's going to be a negative outlook for the market. Yeah. The other two properties that are important for them is Penn 1 and Penn 2, which are their redevelopment assets. They'd gotten some traction on Penn 1, but Penn 2 had been pretty quiet. So we'd certainly be looking at an update there as well.
So you have an underweight and a $12 price target on a stock that, as we've pointed out before, has had a really tough decade, basically. What, if anything, turns it around?
Yeah, we've been concerned about the refinancing risk in the office space as well as Vornado specifically. We think investors need to see more progress on delevering. And that could come in different ways, right? That could come with asset sales to reduce leverage, which is tough in this environment given how rates have moved. And I think the other way it could come about is if the company is able to grow out of it, again, which becomes a very tough prospect if people are not really coming back to the office. We're going to be watching Farley really closely. They've talked about being able to add a mortgage or maybe even sell a piece of that asset to reduce leverage. That could certainly get us more positive if we start to see some traction there.
Incredible to look how it was a $75 stock for most of last decade, and yet here we are at 20. So not one of your favorite names. The next company is, though, it's Simon Property Group. They also report after the bell, faring better than Vornado, only down about 7% the past couple months. Street wants to hear about further investment in retailers. Any updates? I didn't realize they had a stake in Shein, the Chinese retailer. That's interesting. Mall occupancy rates also in focus after management last quarter said they expect it to top 95% and are still hoping to capture more luxury consumers with in-person experiences. Has the stock been a disappointment to you? Is it a definite buy here?
Yeah, we think so. So this is one of the more interesting value opportunities in the entire REIT space. It's trading at about 9 times earnings, and we are very cash flow focused. And if you think about Simon Properties Group's business, if they can generate $4 billion of free cash flow every year, that's well able to cover the dividend at about $2.6 billion and leave a plenty amount of capital to reinvest in the business. So the reason we think is interesting is, I think you're absolutely right. The core business has actually been doing better than expected. So occupancy is getting back to 95% or higher. Releasing spreads are picking up. The NOI, which they lost during the pandemic, they're going to have it all back by next year, which I think is very interesting. I think the reason the stock has sort of lagged this year is because there's been a lot of noise around their retailer investments. So they've owned, JCPenney, Aeropostale, a lot of different brands, including Eddie Bauer, and the retailer investments have underperformed this year. It's only about 5, 6, 7% of their earnings, but every quarter it's looking like a miss, even though the core business is doing well.